tendency that most financial commentators, advisors, gurus, and economists have to see a bubble whenever the markets of pretty much any particular asset rises. We've seen that especially recently with the stock market, and even some talk with real estate prices going up too fast lately. But no other fear is more widespread than the supposed bubble in bonds. The basic idea behind this bond bubble, well, the talk is true. With bonds, the way they work is that as the interest rates increase, then the value of the bond decreases. And the inverse relationship is also true. As the interest rates decrease, the value of the bonds increase. So, of course, rising rates mean that we will have falling bond prices. So with rates being so low, I don't think that investors should expect the same types of returns from bonds that we have seen in the last few years. But that doesn't mean that an increase in rates would be as bad as you think. To understand, you have to first examine why you hold the bonds in your portfolio. If you were holding the bonds, individual bonds, strictly for their income, then to maintain your lifestyle, then it really doesn't matter what interest rates do to the value of your bonds, because assuming no default, you will receive your income and you will receive your entire principal at the maturity of those bonds as expected. So the effect of interest rates rising has no effect or any effect on you while you hold the bond, and at maturity you can actually now take that principal you received and go reinvest it in higher yielding bonds. If you hold the bonds in bond funds, you must understand that those bonds are specifically there to lower the volatility and risk of your portfolio. Although you're receiving income from those funds, the main purpose is for risk management. You must also know that the fund will also replace the lower yielding bonds with higher yielding bonds as rates rise. Remember that over time, the interest income and the reinvestment of that income is the largest portion of the total return for bond funds. The income generated from those bonds will help offset any principal loss of those bonds as the interest rates start to rise and the value of those bonds go in the opposite direction. So the thing to also understand is that bond pricing has more mathematical relationship with interest rates and time as it pertains to the value of the bond than stocks do. The volatility in a stock is much greater than that of a bond. In addition, you must also understand that as interest rates increase, they do increase slowly and gradually. It's not like one day you'll see a quick, large movement in interest rates. So what do we take from this? Well, unless your bond portfolio has unusually really long durations, which our bond portfolios don't, a large drop is far more likely you will see a drop more likely in your exposure to stocks in your stock portion of your portfolio than you'll see in your bond portfolio. Plus, just like you're diversified in your stock portfolio among different companies, among different sizes, among different countries, and among different classes of stocks, you also have the same diversification in your bond portfolio as well. So going forward, rising rates, it's going to be challenging, but rising rates are simply not the looming catastrophe as the commentators, gurus, advisors, or whoever have said that they're going to be. So I wouldn't be too concerned about it. Remember, get our books right here on the left-hand side, and I'll see you next time on Financial QB TV.